Hi trader, welcome to Elite Currency. My name is Chris and today's video is focused on trading the breakout after the pattern break. So we're going to share why and how to do it and why it is also such an advantage. So trading breaks, as you know, you might bump into the problem of false breaks. It looks like a good breakout, but all of a sudden price reverses against the breakout and does the opposite. And you're left wondering what happened. So we shared a couple of tips how you can avoid those false breakouts, and 5 tips. One of those, in fact, was trading the break of the break. And we received some positive feedback on that, so we wanted to share you more details about doing that. So it's basically break of the break is to help avoid false breaks. So let's dive into how to do that. There are 4 steps in total. This is the first step. And basically, it's simply find the correct pattern. Now, that might sound simple, but here are some tips to make it better. First of all, we can use classical trend lines to indicate chart patterns. Nothing fancy. We can just keep it simple. And those purple trend lines indicate a bear flag chart pattern. We can use different time frames, all right, to find the best pattern on that time. So what I mean with that is that if you are looking at a time frame in an hourly chart, but you don't see the entire pattern on the hourly chart, then it could be good to look at a 4-hour chart, so you do see the entire pattern. Or if the pattern is so small, right, it's just like a couple of candles, then you better zoom in to see the pattern on a lower time frame, so you see more candles, you see more structure of that chart. This particular bear flag chart pattern with the purple lines is perfectly fine. We see the pattern, no problem. It's a decent size. It's fine. Even a flag that would go all the way from here almost to the end is fine, as long as you can see it on one chart. And I'm using a chart that has 150, 200 candles, something like that. So you can count that by clicking on the left candle and dragging it all the way to the right, and you'll see a counter. So, that's roughly the zoom level I use. That's a good time frame. This is a perfectly time frame for a 5-minute bear flag. Nothing wrong with it. Momentum before it, bear flag, momentum after it. So this is the correct time frame. Then we're waiting for the chart pattern breakout. Simply price pushing through the trend line. For instance, here you can see a contracting triangle, chart pattern, price breaking through the resistance, making a bullish breakout. So when price is breaking through a trend line like that, this is a chart pattern break. Step 3 is measuring the breakout point, which means looking for good candlestick breakout. That means a good candle close near the high for a bullish breakout, a good candle close near the low for a good bearish breakout, and a decent sized candle, not too small. Medium or above medium, larger, very big candles are fine. So when you have a good breakout candle, then you can zoom in to the next, or I should say move on to the next step, which is trading the break after the pattern break. Now sometimes trading the candle itself is perfectly fine, right? But this gives you a little bit more insurance in a way, a little bit more security and certainty. Because as you can see here, the blue line, the vertical blue line here, is when the breakout candle was confirmed. All right? Another way of tackling it is instead of trading the breakout candle, we can wait for, on a lower time frame, mind you that the breakout is, in this case, on a 30-minute chart, and we can zoom into a lower time frame, like a 5-minute chart in this particular example, and then wait for a new pattern, a smaller pattern. So we just had a 30-minute flag break or triangle break, right? And we're looking for a new pattern. When a new pattern arrives, like this, a bull flag or triangle formation on a lower time frame, that means that the likelihood of a false break is very small. Why? Because price has shown momentum and is going sideways. All right? So that means that on this time frame, there's no incentive, there's no signal that a reversal was coming and that the breakout was false. When we see momentum followed by correction, a breakout to the same direction, a continuation basically, is very likely. So when we see a pattern like that on a smaller time frame, there's a great opportunity to trade the continuation without running into the risk of a false break. So when you see the break of the next pattern, the second pattern on the lower time frame, when you see a break of the bull flag, the green lines, then it's time to enter. So this purple box basically, upon the break, upon the pullback, upon the continuation of the smaller time frame pattern, are all opportunities to trade the breakout, all right, on this time frame. And I'm using 30-minute and 5-minute, of course, as an example. If we see a daily chart breakout, we can zoom into the 4-hour chart and wait for a pattern on that. If we see a 4-hour pattern, we can zoom in to the 1 hour or we see a 4-hour break, we can zoom into the hourly chart for a new pattern on that. So hopefully that's clear. If not, all right, always feel free to reach us, of course, through Twitter, through our email. You can check out our website too, a lot of free material there. Start package has tons of indicators and handouts and ebooks. And if you like this particular video, of course, we'll welcome all shares, likes, and subscribes. Wish you all great trading and talk to you soon. Cheers.